Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Another day of big bank beats. Santander and UBS smash earnings estimates and back guidance. We will hear from the UBS CEO Sergio Ermotti very shortly. But tariffs upend autos as Mercedes withdraws guidance for the year, while Volkswagen sees a 40% plunge in earnings for the quarter. Plus, the US president marks 100 days in office with a rally defending his trade policy and doubling down on criticism of Fed Chair Jerome Powell.
In the meantime, a quick check on the markets here. Take a look at the futures. They are virtually unchanged right now, both in the Euro Stoxx 50 futures and the FTSE 100 futures. It is the last day of the month, so a lot of this may be kind of subject to some of the rebalancing flows. In addition to digesting the earnings story, at least that's going to be the focus over in the States. Already, NASDAQ 100 futures on the back foot ahead of those mega tech earnings, down by about 0.6%. But risk sentiment also weighing in the commodity space. Take a look at Brent crude, $63 a barrel. NYMEX below 60. The countdown to the opening trade starts right now.
Wednesday the 30th, good morning. I think Anna said it brilliantly. The big bank beats is the story of the morning. You've had numbers out from UBS. You've had numbers out from Santander, Caixa, Soc Gen. All of them on the front foot. All of them really delivering when it comes to the trading narrative. Soc Gen really stands out to me. The 14% profit before tax beat, really signalling that this bank is back on the front foot, as are so many of these European banks. Buyback hopes are being raised. This is a front foot story for European banks, but keep an eye on the cost line. Lots of things going on below the surface at the moment. We're going to be speaking to Credit Agricole, a tax hit there. Yes. So there are nuances between the different stories.
Yeah, there are. It does feel as if this quarter, this isn't the sector you necessarily need to worry about when it comes to tariffs, but how much of that is just a delay? You know, this will feed back to the underlying economies that these banks rely on at some point.
And some of them showing up in the likes of Santander, doubling down on the exposure to the U.S., whereas others saying, maybe we got to kind of have to balance this out a little bit. I think it's also fascinating. I'm having a bit of COVID deja vu, that the volatility...
Don't do that.
But the volatility of that era really reflected well for the banks initially because they were trading off of this, and we're seeing the exact same thing happen right now.
But the question now is the sustainability of this story, and I think that is going to be the big factor going forward from here. You have seen these big beats coming through. As you say, there's potential underlying weakness coming through for some of these institutions. Can the trading story mask that? I think that is one of the critical questions that we need to be thinking about, and it's a conversation that we've been having with the UBS CEO. Sergio Ermotti has been speaking to Bloomberg's Tom McKenzie. They kicked off their discussing the sustainability of that trading story.
When you look at wealth management, asset management, and the investment bank, both delivered double-digit pre-tax profit expansion. Our core businesses had a combined 15% expansion. So I think that, of course, we saw a little bit of seasonality, positive seasonality, particularly in the first few weeks of January. I think it's fair to say that afterwards, the seasonality factors were out, and a high level of uncertainty and volatility did come in. But the most important issue is that if you go back in history, you can see how we can really perform in a variety of market conditions.
Wealth management, clearly the biggest profit driver, as it has been for a long time for UBS. How are your clients within wealth adjusting to the market turmoil, the political uncertainty? Are they staying on the sidelines? Are they looking for different products, different asset classes?
Well, you look at, so far we haven't really seen a major shift in asset allocation by clients. And when you look at the first quarter and the first couple of weeks in April, they took more advantage of market volatility to reposition their exposures within the already set asset allocation. When you look at the last couple of weeks, it's fair to say that probably there is a little bit of fatigue coming in from news, coming from the trade tariffs situation. So, but for the time being, I have to say that despite a real significant spike in volatility and huge volumes, we saw peaks in volume that exceeded 30% of the COVID times in the first couple of weeks of the second quarter. So, despite all of this, clients are quite calm and focus on managing within their asset allocation.
Is that volatility, that peak in volatility behind us now, do you think?
I don't think so. I think that's, as I said, probably now there is a little bit of settling down. I think markets have found probably a new dimension in terms of where to reconsider things from, and now it's going to be depending on the developments on the tariff front. I think that uncertainty is there. It's very positive to see that there are ongoing discussions in terms of finding agreements. Having said that, if this goes on for too long, uncertainty has also a cost, and therefore probably investors and corporates will slow down their investment plans.
How are your private banking clients being impacted by tariffs?
No, for the clients themselves directly in their asset allocation, just as a function of markets movements. Of course, we have a lot of clients who are also entrepreneur business owners, and there it depends very much where they are. So I think the tariff issue won't be a game in which everybody loses or everybody gains. Some people will be winners, some people will be losers.
You definitely want to be on the winner's side of that fence, don't you? Sergio Ermotti, the CEO of UBS, speaking to Bloomberg's Tom McKenzie in Zurich a few minutes ago. And the banking story continues. We'll park UBS for a moment. We'll come back to it. But Barclays is now on deck.
Yeah, absolutely. So Barclays numbers keeping up this theme of strength coming through from the banking sector this morning, and then raising the bar a little bit, it seems, because not only sticking to some of their guidance, but actually boosting some of their guidance. So boosting their 2025 guidance for the group net interest income, which is interesting. They are breaking down the various parts of the business, of course. Q1 investment bank revenues coming in better than had been expected. No doubt there'll be quite a lot of focus on how the structural hedge has been performing around the UK, and I saw some positive lines. Yeah, they see full year UK net interest income above £7.6 billion. So we'll see how this one goes down, but it seems as if there no signs of worry and concern so far coming through from the statement at Barclays.
Well, let's go from the banking sector to the energy sector. Total is another one that's catching our eye this morning. Those numbers crossing the wire as we speak. The focus here was profit, and the focus here was shareholder returns. And on both, they kind of seem to be showing a little bit of a mixed picture. I'm looking at net income that is coming in less than the estimates. But the concerns around the buyback seem to be very much in place still. Up to $2 billion in the second quarter. It was largely expected, so no wobbles there. But the net income not painting a positive picture.
I see you and I raise you. The car sector is ugly this morning. It is really ugly. So the latest piece that we can fold into the narrative is Stellantis. Stellantis has effectively withdrawn its 2025 guidance within the last few minutes. It is posting a sales slump as well. Revenue down 14% to 35.8 billion in Q1 from a year earlier. That's the year-on-year comparison. So down 14%. This follows a series of other automakers that have been posting numbers this morning. You've already had Mercedes this morning withdrawing its guidance as well. It just says the volatility is too great. It doesn't have enough visibility to be able to give investors a good guide as to what is happening here, which is a pretty worrying situation. Volkswagen's also out as well. Obviously, one of the giants in the space, talking about return on sales being at the low end of the 5.5 to 6.5 range. It is sticking to its guidance, but basically saying it's sticking to its guidance without the tariff news folded into it, which is just bizarre.
Line. Yeah, absolutely. So they're guiding to the lower end of the range, as you say, in terms of that sales growth range, guiding to the lower end of the range, but that is even without any tariff impact. So it's not even just a bit of tariff impact.
Is that useful? Clearly there is going to be some sort of a tariff impact. VW does have business in the United States. It is going to be affected by what is happening with the global market. To say that and just say, is that... What is the purpose of doing that?
We're back. I suppose we're back to that thing that some corporates are adopting this approach. If we have so little visibility, we don't know where to take the numbers. We stick to the numbers we had some way of calculating in the first place, and until we get more clarity. I was taken by Valeo as well, small player, but car parts overnight. No change in guidance there. And actually, I thought, and revenue numbers coming in line. So maybe that counts as outperformance for the auto sector today.
Can I just... Agricole's numbers are also interesting. We're going to be speaking very shortly to the bank. The fourth line on the deputy CEO's deck this morning, fifth line, consumer finance is down, affected by a decline in car financing. So there is a tariff effect here, but I think there is also a broader kind of what is happening in the auto market effect as well, which was already struggling before we folded in what is happening with the tariff narrative.
Well, this is just a great microcosm of exactly the issues that we're seeing over in the States as well, which is that there are these three buckets, the ones that are still benefiting, that aren't really being hit as hard, the ones that are saying we don't have visibility, we are suspending our buybacks, and then the third that's saying, like the automakers, we're getting crushed. And we saw that in the likes of Honeywell, UPS, GM last week as just some examples of those three buckets.
Can I just fold in Snap, which I thought was really interesting as well, just a lead indicator as to maybe what is happening in the advertising space. Snapchat, yeah. It is... You love tickers, like Snap. It was withdrawing guidance as well.
Yeah.
It basically doesn't have enough visibility on the advertising story. And you look at what is about to... Meta, we're about to get Meta. That's the kind of the one you want to be looking forward to. Snap doesn't have enough visibility at this point.
And we are 100 days into the Trump administration now, this week, marking that. And you wonder whether the visibility gets any better from here or not.
So more oscillation last night, I would argue. Speaking in Detroit, talking about what his first 100 days have delivered, he was talking very positively. But he's also back to bashing Powell as well. We're talking about President Trump here, by the way, if you hadn't kind of caught up with that narrative. He was talking about it very positively his first 100 days, but he's coming back to some of the familiar themes. China is one of them, on what is happening as well with the Fed. Take a listen to what he had to say.
We will end inflation, slash prices. We've already ended inflation, raise wages, and give you the greatest economy in the history of the world. That's already happening. You're not supposed to criticize the Fed. You're supposed to let him do his own thing. But I know much more than he does about interest rates, believe me. I'm proud to be the president for the workers and not the outsourcers, the president who stands up for Main Street, not Wall Street. You know, I like Wall Street.
I like Wall Street. Does Wall Street like him? Some do, some don't. It's a mixed picture right now, but there's certainly significant volatility at the moment, which is helping trading, which we've seen already this morning, and we're going to get more on that very shortly. We're going to be speaking to a series of banks over the next couple of hours to give us an idea of what is happening with that volatility and what it means for Wall Street. Jose Garcia Cantera, Banco Santander's CFO, is going to be joining us. Jerome, Credit Agricole Deputy CEO, is going to be joining us as well. We'll get Peter Oppenheimer's take on what is happening here. Goldman Sachs' Chief Global Equity Strategist, and Jennifer McKeown will be joining us from Capital Economics, Chief Global Economist, to talk about what is happening out there. You've also got the China data to fold in this morning. That was quite ugly. The PMI dropping below 50, below expectations. Again, just a derivative, you could argue, of what is happening with the Trump trade around the world.
Yeah, absolutely. And talking of trade, watching those port arrivals, that 60% much talked about drop in port arrivals from China into the United States. We're watching all of that kind of data, watching South Korean exports, watching anything that's going to give us a sense of where the toll of this tariff onslaught, this policy onslaught of the first 100 days, where that will fall.
It's fascinating that we're coming back to that kind of trade data and the port data consecutively, because if you actually widen out the chart, it's the latest leg lower of an ongoing trend that you've seen for the last 5 years or so. And I think it's the margin of the move, as we talked about in the bond market, for example, that's spooking everybody. But we have seen these levels of drops before. For example, in 2022, when the market was crashing, we saw legs lower of the trade story. So I'm curious how much of the economics is driving the markets, how much of the markets is driving the economics.
It's really hard to separate out at the moment, because you've got so many lags in the system.
Yeah.
And we're trying to understand those lags and trying to understand kind of what is relevant now, what should I be focusing on now, what does that tell us about what's going to be happening in the future, and how distant is this data in terms of the relevance to now.
And how much does this all cut through to Main Street, as President Trump likes to talk about? And we saw consumer confidence yesterday down to a 5-year low, so it seems as if this does cut through. It isn't just us in the financial markets and financial news networks talking about what is happening here. There's a lot of nervousness.
He was elected on bringing inflation down.
Yeah.
And there's still a lot of volatility in that inflation data. And the Fed is clearly still nervous, which is why maybe it's not cutting rates in the way that maybe the president will be looking for. Let's talk about what else you need to know this Wednesday morning. President Trump and Canada's re-elected Prime Minister Mark Carney have spoken and agreed to meet in person in the near future. The Canadian Prime Minister's office says the two agreed on the importance of Canada and US relations and working together as, quote, independent sovereign nations. Carney's Liberal Party is on course to fall short, though, of an overall majority in the House of Commons. Keep an eye on that story because that's going to provide some background volatility. Bloomberg has learnt that that Vladimir Putin is insisting that Russia will take control of 4 regions of Ukraine. It doesn't fully occupy as part of any agreement to end the war. The demand deals a blow to President Trump's efforts to reach a ceasefire. Sources in Moscow say that the US envoy Steve Witkoff tried during lengthy talks last week to convince Putin to agree to a ceasefire based on the current front lines. And Spain's power grid operator says a series of disruptions over a few seconds triggered Monday's widespread blackouts. However, Red Eléctrica says it still doesn't have a complete explanation. The Spanish government is not ruling out a cyber attack, although the grid operator denies there was a hack. Prime Minister Pedro Sanchez has pushed back against opposition claims that expanded wind and solar generation were to blame for the failure.
Coming up on the programme, US tech has another big week. Microsoft and Meta report later today. We will preview those results. Plus, autos suffer a tariff hit, but also a potential reprieve from Donald Trump. Oh, yes, there was that last night at the margin. We will check in on those stocks at the open. Up next, Santander's CFO joins us to talk about his bank's latest earnings. How has the lack of power in Spain over the last 24 hours or so, or going back 24 hours, how did that impact on the business? How resilient is Spanish business? If you have questions for our guests, if you want to get involved in any of these conversations around this desk, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Wednesday morning, good morning. Don't bother looking at futures. To be honest, they're not really telling you very much this morning. You've got very small moves on the screen in front of you. Below the surface, though, there is a massive amount of churn. The banking sector, on one hand, absolutely front and centre. The auto sector largely withdrawing guidance this morning. What is going on there? So there's a lot of things happening at the moment, but it's not happening at the surface level when it comes to index futures right now, Kriti.
It's happening on the micro level, to your point, specifically in the earnings picture. Let's kick it off with some of the bank earnings. We're getting a slew of them this morning. Santander, of course, one of the early reporters. Let's just walk through some of the numbers here. Posting first quarter profit that exceeded expectations. On top of that, announcing fee income that hit a record. Joining us now is the CFO of Banco Santander, Jose Garcia Cantera. Jose, pleasure to have you on the program. Thank you so much for making the time for us this morning. Now, these numbers look very strong, but I want to take a big picture approach to my first question to you, which is amid all of this kind of record fee income, you're also talking about doubling down when it comes to the United States and Latin America, pulling back on your exposure to Europe. That's a very contrarian investment choice at the moment. Can you walk us through the logic of that?
Well, we believe, first of all, thank you for having me in the show. And yes, first quarter results hit another record high, 3.4 billion, almost 20% growth year on year. And this was based on our 3 competitive advantages, which is basically our geographical diversification, the fact that our transformation program is doing very well, and that our network businesses are also doing very well. This diversification, being in Europe, being in the US, it's one of our key advantages. Obviously, we want to be a relevant bank in both regions. We are already a very relevant bank in Europe. We are the largest bank in the Eurozone by market cap, but we also want to be relevant in the Americas, and particularly the US. US is a very large economy, is the largest financial sector in the world, and we want to be relevant in the US. This is a long-term strategy. We launched Open Bank just 5-6 months ago, and we have already captured 100,000 customers at Open Bank. We have $4 billion dollars of deposits. Our corporate investment banking, our corporate business in the US is doing very well, and our auto business also did very well in the first quarter. So again, long term, we want to be a relevant bank in the Americas and in the US in particular.
A long-term strategy that I think a lot of folks would agree with. But in the short term, Jose, what is that costing you as we talk about a real pullback from the region, and certainly in terms of navigating not only the tariff risk, but also the volatility as well? Are you seeing cracks show up in your numbers?
Not really, rather the opposite. As I said, in the US, we are doing very, very well. First quarter numbers exceeded everybody's expectations. Our return on tangible equity in the US in the first quarter, adjusting for the excess capital we have, was already 14%. in dollars, very much aligned with our target of 15%. And if you look at Latin America, Latin America is the region that is being the least affected by the tariff increase around the world. While in some economies we've seen GDP growth being revised downwards, in others, in particular in Brazil or in Spain, GDP growth figures have been revised upwards. And again, this is the benefit of our diversification. So Latin America seems to be today the region that will probably benefit from what's going on with tariffs. So being in Latin America is actually a positive thing for us, and this is showing in the numbers.
OK, so you say Latin America a positive thing. Jose, good morning. Sticking with going around the world and thinking about geographic exposure, I don't know what you can say about your plans with regards to Poland, but we've seen reports that Erste is in talks to buy $8 billion of the Santander Polish unit, a stake in that Santander Polish unit. Can you say any more about that? Does that fit in with the reorientation of the business that you've just been describing?
Yeah, we said this week that we received interest from different parties, and we have engaged in conversations with Erste to buy a 49% stake in the bank. However, there is no guarantee, no certainty that these conversations will lead to a transaction. Our Polish bank is doing extremely well. We had a great first quarter, earning 20% return or slightly over 20% return on tangible equity, growing very, very well. But like we've said in the past, we have the fiduciary duty to look at buying opportunities in the regions where we operate, in the countries where we operate. We also have the fiduciary duty to look at selling opportunities.
And can I ask you about then what you do with the money that you raise from that? You've talked very positively about North America, about Latin America. So money you raise from asset sales in Europe, is the plan that that gets shifted to the Americas?
As I said, the negotiations are still ongoing, and there is no certainty that this will lead to a transaction. So I think it's very premature, and it would be speculative to talk about where to put the money when we still don't have the money.
Fair enough. Can't argue with that. Jose, good morning. It's Guy. How did the bank cope with the blackout? And do you think this is an advertisement for consumers to continue using cash? In certain situations, cash does work.
Yeah, I mean, this was a one-off that, it shouldn't have happened. In reality, the economic impact of what happened a couple of days ago in Spain is going to be very, very minor. Probably 0.3% of second quarter GDP. That's less than 0.1% of GDP. Recently, the IMF and others have increased Spain's GDP growth estimates for the year to 2.5%. And obviously, this is not going to derail the very good performance of the Spanish economy. In terms of consumers' behavior, again, I think this is a one-off that I don't think it will change much the long-term trends that we've seen recently.
OK, let's talk about other long-term trends then. Can I take you back to America? You talk about wanting to be a relevant bank in the United States. Can you just give me a sense of what kind of economic backdrop you think the United States is dealing with right now, and how your credit portfolio is how your credit position will kind of evolve? There are some that suggest that the United States is heading towards a recession. What kind of economic extremes are you planning for in the United States? And how robust is your book were we to see a recession?
Well, we are obviously monitoring the situation very closely and updating the macro outlook. As I said, so far we've seen the revision of some GDP growth in some economies downwards, but some others upwards. So in our case, the overall impact of what we are seeing it's small. That's why we are reiterating our targets for the year. Specifically in the US, we are not predicting a recession or seeing a recession this year. It's true that GDP growth was cut from close to 2% to slightly over 1% by the IMF a couple of days ago. But the behavior of the customers that we have in our auto business in the first quarter was really good. We saw an increase in car prices in anticipation of probably supply chain problems going forward, and unemployment remains very robust. So we are not seeing any impact so far in the US or elsewhere in terms of credit quality at all.
Are you planning for that to change, though? You're not seeing the impact yet. Some other lenders are already talking about credit quality deteriorating. You're saying you're not seeing that, but you are talking about a slowdown in the economy. What order of magnitude, as we go through this cycle, do you think we're going to see within your book? What are you planning for? What are the parameters you're working with?
I think the key, again, is the labor market. So as long as unemployment remains at, low levels similar to what we have today, maybe up 0.1%, 0.2%, that should not lead to a significant asset quality deterioration. Also, take into account that part of our business in the US is based on the used car prices. It's used cars, it's leasing and subprime. And we've seen used car prices starting to go up following the trend of higher new car prices as well. And this is countercyclical. So we actually feel quite comfortable with the guidance that we've given in terms of asset quality for the year.
Thank you so much. Thank you for your time, Jose Garcia-Quintero, the CFO of Banco Santander. We do really appreciate it. Not giving us a very negative read then on the US economy. And they have exposure, and they are increasing their exposure to various parts of the Americas.
It's very critical, though, to look at which bits of the economy they are exposed to. So cars and subprime is
used cars.
Used cars. So used car prices, which is, again, throwbacks to what we saw during the COVID crisis. Used car prices went up, not down.
They went up, but he's talking about so much of that kind of gain being front-running the tariffs. The delinquencies are coming up as well because you're seeing the prices getting charged for this.
And that's going to be the problem about so much of the data, isn't it, in the first quarter? Front-running of the tariffs could be the issue. Labour market's going to be quite important. Yes. The payroll's coming up on Friday. Anyway, up next, we're going to talk to another bank. Crédit Agricole out with numbers. We'll talk about them next. This is Bloomberg. Welcome back to the programme. 7:30 here in London, so 30 minutes until the start of trading here in Europe. We have so many earnings coming through this morning, plenty of those to factor in at the start of trade. So we are expecting a slight uptick in stocks at the start of the European session, but we'll see what is happening under the hood, if you like, because banks have been delivering a really positive story, autos delivering a negative story. Meanwhile, US futures track a little weaker this morning. Nasdaq futures weighed on by Supermicro, I think. We wait for some bigger, more important tech earnings out of the States later on today. And with bond markets in mind, we've seen a number of days where Treasury yields have been coming down, and we still see that actually at the 30-year horizon. And this is the picture across European bond markets right now. A little bit of buying, but really not very much. Guy?
Let's get back to the banks. We've done Swiss banks, I think, so far. We've done Spanish banks. Let's see some French banks. Crédit Agricole out with numbers this morning. Strong trading. I think that is a feature across the landscape of the banking sector this morning. But when it comes to France, there's also a tax factor you need to fold into the narrative as well. Jerome is the deputy CEO of Crédit Agricole. Jerome, good morning. I've got the slides from your deck this morning and the presentation that you're making. You lead with the new record achieved by the CIB. You talk about record inflows into the asset management story. Yet I'm wondering whether the party this morning is being slightly overshadowed by higher costs and higher taxes. Which one do you think investors should be focusing on? Which of those two buckets, the good bucket and the bad bucket?
Clearly, the good bucket is the most important part of the story. Revenues globally for Crédit Agricole SA post a record high level at 7.3 billion euros for the quarter, up 6.6%. And the net profit before tax is up 4.5% this quarter. So definitely, it's a good set of numbers. The only, I would say, gray area, but this is an area that we had anticipated a long time ago, is the fact that the French government has decided to implement this year a specific corporate tax surcharge on the French corporates. And as we have a significant part of our revenues and our profitability that is generated in France, we have a high level of taxable basis in France. We are generally a very highly ranked taxpayer in France, and as this specific surcharge is only an add-on on the normal level of corporate tax in France, we are having a significant impact. And so this is transforming to a certain extent a net profit before tax that was up 4.6% into a net profit after tax, which is slightly down, -4%. But I think that globally, the underlying picture is very positive.
What about costs? What is happening on that front? What more can you do to control the cost picture?
The cost basis is apparently significantly up, around 300 million euros additional costs this quarter. But actually, if you analyze a little bit what is inside this increase in the cost basis, you have a very important scope effect. In the cost basis this quarter, we have the costs related to the Groupe Petercam that we acquired in the middle of last year. So it was not in our scope of businesses 1 year ago. And we have also some integration costs. And last point, we have also some additional taxes that are hiking this quarter as every first quarter of the year. So restated from this element, the underlying normal recurring cost basis is up 3.2% this quarter, which is perfectly in line with the level of inflation and with the organic development of our businesses.
Jerome, it's Kriti in London. Let's go from kind of the micro and the individual earnings lines from your bank to how you're approaching perhaps the Italian banking story as well. I believe this morning the CEO of Crédit Agricole talked to reporters saying that their decision around Banco BPM and the support there is still not a done deal. Jerome, what factors are you taking into account when it comes to supporting or not supporting UniCredit's takeover of Banco BPM, a bank that you have an almost 20% stake in?
No, this offer has started only last Monday, so 2 days ago. It's intended to last 8 weeks at least. So, of course, we need to wait for the last period of this offer duration before making a decision, because we need to have on the table all the elements that we need to know in order to take the best possible decision. And what we're doing in Italy, not only since yesterday, but since decades, is to develop our own network, our own setup of activities, and to increase regularly and permanently the contribution that we provide to the financing of the Italian economy. So we are going to take a decision on this offer at the end of the period, so probably in June, mid-June, and we need to know as much as possible all the elements that we have to take into consideration before making a decision.
So in providing that value to the Italian banking sector, as you suggest, what other players, or are there any other players you're looking at in terms of partnering with, in terms of stakes? Are you looking at the broader Italian banking space, or is this a Banco BPM specific story?
We are first an Italian bank with an Italian network, which is not in the podium of the Italian banks, but which is very significant nevertheless, that has been developing rapidly over the last 5 or 10 years. And we intend to continue to develop our network, which is branded Crédit Agricole Italy. Then we have also implemented all our specialized businesses in Italy: consumer credit, asset management, CIB activities, insurance activities, and we work at the same time with our own network and with some partners. It happens that we are partnering with BPM on certain businesses, consumer credit and P&C insurance activities, and we are partnering with UniCredit on another very important business, which is asset management. And what we intend to do is, of course, to try and develop at the same time our network and the partnerships that we have with other banks. And we will continue to try and find a way of doing both at the same time.
OK, we'll keep watching the complexity of the Italian banking landscape, Jerome. And expansion in Italy has been a feature of the tenure of the current CEO. So Philippe Brassac, he's been in post, of course, for a decade-long tenure that's seen considerable expansion in Italy. He makes way for Olivier Gavalda shortly. Which geographical focus should we look to under the new CEO?
I think we are not going to change radically from the scopes that we have. We are a French bank, which is very, very powerful in France. We have a European scope, and actually it happens that in Italy we are quite visible because we have a network which is branded Crédit Agricole Italy, but we have some significant activities in Spain, in Germany, in Belgium, now that we have acquired Banque de Groof Petercam. And so we clearly have a European focus, and we will intend to continue to develop this European focus. And then besides, we have some activities which need to be global. It's the case for our CIB activities, which is a global CIB. It's the case for our asset management activities. Amundi is a global asset manager.
Okay, and Jerome, you have a good take on the European economy then. What weak spots do you see in the European economy, and are you confident the ECB will keep cutting rates to support it?
Well, the European economy is in a very specific situation nowadays, because at the same time there is the threat of tariffs, the threat of a global slowdown of the economy because of some erratic decisions that may be taken or not the other side of the Atlantic. But at the same time, it seems that Europe is clearly an area of stability, an area of predictability in terms of regulation. And so Europe should benefit in the long run of all this instability that is developing globally. So I'm very confident for the future development of the European economy. Then when it comes to the short term, I think that indeed the ECB will continue progressively to converge to the neutral rate, which is probably around 2%. They've taken a significant number of steps in the last 1.5 years. I don't know what is going to be the pace of the future cuts, but I expect this is going to progressively, again, go to this neutral level of rates.
Yep. Jerome, final quick question. Let's bring it all together. The European economy is, as you say, in a position where it maybe has a long-term opportunity. You are seeing some one-offs in this quarter. Taxes, costs are all having a factor at the moment. I'm wondering, can you just give me a bit more visibility on the guidance going forward from here? What do you expect to see next? What are you seeing? Are there any indications, and we talked about this with Santander just a minute ago, any indications within your credit book that consumers are struggling right now? What are you seeing in terms of forward metrics that you can see in your data that tells us about, A, where the bank is going, and B, where the economy is going?
It's clear that all these political uncertainties that have been developing in the last, let's say, 6 months, both in France with all these changes in the government and globally with the decisions made by the US government, have created some, I would say, attentism, wait-and-see mode amongst different economic agents. But nevertheless, what we are seeing in our numbers of the first quarter is a good level of activities for corporates, clearly. And what we are progressively seeing also in the, I would say, more day-to-day figures is a pickup in the credit demand in retail activities in France, from household for home loans, but also to a certain extent for some segments of small businesses. So we are positive again for the rest of the year, of course, depending on the final outcome of all these discussions that are taking place around tariffs, around geopolitics, and so on and so forth.
Yep. Jerome, that's really interesting. Thanks very much indeed for updating us. Thank you very much indeed for spending so much time with us as well this morning. Jerome, the Deputy CEO of Crédit Agricole. OK, so we've got an idea of what is happening in the French economy. Interesting what he had to say about what is happening in terms of credit demand for small and medium-sized companies and also the consumer. The inflation picture, though, obviously comes towards all of this as a big factor as we think about what is going to happen next. We are going to get French CPI breaking very, very shortly. We'll be coming back in a few minutes' time and breaking that data. We'll also look at all of the earnings we've had out this morning. The auto sector very much in focus as well. We'll talk about what is happening there. This is Bloomberg.
We are getting breaking data out of France this morning. I'm looking at a CPI number here of 0.8% on a year-over-year basis. The survey number was 0.7%. So coming in just a little bit hot as we look at the numbers. Euro-dollar not reacting too much, just ticking higher just a little bit. Still at a 113 handle, though. When you look at the data, a good chunk of the rise seems to be coming from food prices. Energy prices, however, dropping. So that's going to be something that reflects in, of course, the core Eurozone data, but also ticking up higher in terms of the French data as well.
We're about to get the market open, 13 minutes away here in Europe. The US equity market has been on something of a winning streak lately. Very short term, but a winning streak nevertheless. As we head into earnings season, does this stack up? And maybe as well you need to think about whether or not you're a European investor or a US investor. Valerie Teitel is here with more.
Guy, the S&P 500 on a 6-day winning streak, up 8% in that time frame. I, for one, was surprised to see that the tech stocks, the NASDAQ 100, has recovered basically all of its losses since April 2nd. Now, where do we go from here? A lot of that might hinge on the data. A lot of it will also hinge on the earnings. We get Meta and Microsoft reporting after the bell, with the rest of the Mag 7 due to report in the next few days. With that focus on Meta, it is going to be on their ad revenue spending. We know that advertising is a cyclical business. Will they give us hints that advertisers are starting to pull back on ad revenue, on ad spend, given the tariff uncertainty? And then with Microsoft, it'll all be down to their CapEx numbers. We know that they've pulled back on some leasing of data centers. Do they give a bullish or bearish guidance on capital expenditures for the months ahead? Now, that's the earnings picture later tonight, but we also have data to contend with at 1:30 p.m. London time. We get the first advanced reading of first quarter GDP for the U.S. If you thought companies were uncertain, Guy, economists are just as uncertain. Take a look at this chart behind me. It is the estimate range from high to low of economists for the GDP print today. 4 percentage points is the range on that GDP print. It's bound to lead to some surprises today. This widest ever range for a first quarter GDP print, Guy. A lot of the attention will be on the import numbers. Just how much tariff front-running was there in the first quarter, and how could that drag on GDP?
Absolutely. It's probably worth pointing out as well, as Valerie points out, the rise we've seen over the last few days in US equity markets. Months to date, the Nasdaq is actually up, unless you're an investor from the Eurozone, where it's down 4.16%. Currencies really matter at the moment, and we'll be talking about that in more detail in just a moment. But let's first turn our attention to which stocks we are watching so carefully this morning. Autos firmly in focus. VW has stuck to guidance, but not really. Mercedes has withdrawn guidance. Stellantis has withdrawn guidance. You see the series of this same story playing out in the United States as well, where automakers are under significant pressure. The stocks are called down this morning, which I think is interesting on TradeGate, the auto sector, but not by much. I think the market was already anticipating that this would largely be the case.
Yeah, absolutely. I mean, we've had, even before tariffs, we knew that car makers were in a tough position, and the tariffs have clearly intensified that. Let's talk about some of the energy-related businesses. We've got Equinor numbers out this morning, operating profit coming in there a little bit below estimates. Weaker oil trading and a drop in the gas price is part of the explanation there. They also had an outage in northern Norway that took its toll. But interestingly, from a sort of geopolitical perspective, of course, the Empire Wind project is something that they are exposed to. They've called the stopping of that by President Trump unlawful. They're trying to talk to the US administration about that, but of course that's taken its toll already. Total in focus, net profit coming in below estimates. Kriti was saying at the top of the programme, continuing their buyback though, still, and sticking to targets, so trying to underscore the extent to which this sector can be insulated from tariff trouble. I mean, if it takes its toll on the oil price, it takes its toll on the global economy, then maybe not. And OMV missing estimates there. They've appointed a task force to assess the impact of tariffs. And I feel like we heard that a few months ago, didn't we, from lots of different businesses. Appointing a task force feels like...
You're doing something, aren't you?
It's the first thing I'd do.
Yeah.
It's a scary time to be a corporate, unless you are the CEO of a bank, which in case you're probably raking in some of the volatility there. You are getting numbers from every corner of Europe. UBS, Santander, SocGen, Barclays. If I could draw a line between all four of them, it's just the volatility has helped their bottom line. Barclays, to me, was the one that kind of stood out of all of them, simply because they're not just talking about volatility benefiting their trading bottom line, but their investment banking story as well. The sustainability of all the positive results you're seeing across these banks is the key one in question.
OK, let's talk about the markets in 3 minutes. So joining us, our Markets Live currency and rate strategist, Ven Ram. Very nice to see you, Ven. Thank you for joining us. Let me ask you about FX markets. You've done a recent piece of work around any expectation of a Mar-a-Lago Accord, something like the Plaza Accord, to devalue the dollar. You say that currency strategists are not banking on this happening. I mean, is that just because the dollar has reduced itself in value quite substantially already? What's your thinking?
Morning, Anna. I think it's because the dollar's recent declines look like mean reversion to me. If you look at what the dollar did in the last quarter of 2024, it surged, the dollar index surged 8%. So what it has done so far in 2025 is merely give up those gains. Those were outsized gains that stemmed from the markets getting ready, positioning for a Trump victory. And since the Trump victory happened, the market has unwound some of those gains, and that's what has happened. So it is merely a mere reversion to the mean. And if you look at, so what is clear is that the markets are not front-running the idea of a Mar-a-Lago Accord. And what is very clear from that modeling work, Anna, is that, if you look at the dollar, it's moving fundamentally in cohesion with how, inflation-adjusted rates in the 5 biggest economies that move the dollar index. That's how the dollar is moving. So there is no, if there is a bigger mean, if there's a bigger deviation in the dollar index's trajectory from the real rates, then you could argue that, look, the market is front-running the possible Mar-a-Lago Accord, but that's not what is happening at all. So the case for a Mar-a-Lago Accord is flimsy as far as the markets are concerned.
Ven, last few days, risk on. Is that the right trade? What do you think?
I don't think it's remotely the right trade, Guy, because if you look at corporate earnings in the US, I think that they are going to take a hit. We are already hearing about shipments plummeting from China to the US, and that means empty shelves, higher inflation, lower growth, and there is no escaping the lower growth. In an environment where possibly the US is heading for a recession, you've got to think that this is going to hurt corporate earnings, and therefore, no matter how much the markets try to set Humpty Dumpty right, it's not going to be set right, because as long as the earnings are going to go down, stocks will go down as well, and that means that risk off is the measure. We are in a bear market, Guy, and that bear market is going to persist for a few months. It can't be overwritten in a matter of weeks. I mean, just at the start of April, we had such a huge plunge in the stock markets, and now the markets are coming back up. So the markets are kind of saying, look, the economy is going to be all right. Well, the fact is, it's not going to be all right, and it's going to be risk off.
All right, Bloomberg Markets Live currency and rate strategist Ven Ram walking us through what the volatility of these markets actually looks like, whether the sustainability of these last 6 days are actually in the cards. I think it's interesting, though, that he's talking about the fundamentals still driving these markets. Isn't the last 6 trading sessions really just more of a rebalancing trade? So I wonder how much stock you can really put into that optimism.
Well, it was interesting to see that bond markets were acting as a bit of a haven again. I saw at least a couple of notes yesterday referencing the role that treasuries have been playing. It seems ridiculous that you have to say that, but given the trading that we saw over the beginning of April, it's important to note. And that reads across to stocks, perhaps. Yeah.
The last few days, I think all of this is right. The last few days have been a reaction to what came before and maybe a reposition from slightly technically oversold positions. But we're going into earnings season now, and the earnings season is throwing out some fairly ugly kind of stories at the moment already. We'll talk more about that in a moment. The European stocks are about to open. We're 5 minutes away. The index levels, I don't really think, tell much of the story this morning. You've got to delve a little deeper into sectors and stocks to get a real idea of what is going on. We are going to do just that next. This is Bloomberg. Wednesday morning, good morning. Indices are interesting. Individual equities are more interesting this morning. It's a bottom-up market. You need to pay attention to the detail, the nuance this morning in terms of the message that is being delivered, sector to sector, stock to stock. Let me tell you, though, despite me saying that, what is happening at the sector level. Bit of volatility in yesterday's session. Remember, we are coming into the end of the month, so that needs to be borne in mind. US equities went out here. US equities rallied a little bit. But after hours, you've got a whole bunch of factors you need to throw into the mix. Today, we get a lot of corporate news, particularly on the tech side. And Snap was worth paying attention to yesterday, withdrawing guidance on maybe a obscure outlook when it comes to the advertising picture, Kriti.
It's interesting because on this side of the Atlantic, we're seeing some green on the screen, some marginal positivity that might be a function of the rebalancing flows that we're seeing, stronger by 0.2% across every major market. But Anna, you look across the Atlantic and futures are deeply in the red. So I wonder if tech, as a guy was talking about, is one of the key sectors to watch among all of the ones we're watching here in Europe.
Yeah, I mean, Nasdaq futures down 0.4%, E-minis down at 0.2%. We'll certainly keep an eye on those US futures. Thinking about the European session ahead then, Kriti, let's have a look at some of the sectors and names that could be on the move. Autos is in focus, as Guy was saying. Mercedes, the tariff volatility is too high for a reliable outlook there. VW, they have guided to the lower end of the range in terms of sales growth, but that's even without any tariff impact, so keep that in mind. And Stellantis suspending their guidance. So this is the sector that is really being bashed about by the tariff narrative right now. That's not true of the banking sector. We've had quite a number of beats from Santander, from UBS, from SocGen, better performance coming through from the banks than had been anticipated, and a lot of them managing to stick to the guidance that they previously issued. Energy also in focus with numbers out from Total, Equinor and OMV, Guy.
OK, but let's talk about this market open this Wednesday morning, figure out what is happening here in Europe. As I say, look below the surface, look below the hood of the story this morning to figure out what is going on. The nuance matters. The individual stock stories matter. The FTSE 100 flat as a pancake. Nothing to see here. Nothing interesting to delve into there. You've got a whole load of companies out of the UK you want to focus on. GSK is one of them. What's happening with Glencore this morning? Pay attention to that. Stock 600 up by 0.1%. As I say, the index is not telling you the real narrative. The Spanish markets up by 0.1%. You've got some of the biggest banks reporting numbers this morning. Again, that is where you want to be paying attention to. So the index story is not telling you very much. What is happening below the surface, sectors and stocks will, though. Kriti, what are you seeing in the sector story?
Well, it's interesting. My eye immediately goes to the energy sector because when you're looking at it from an index contribution, that's where a lot of the pain lies, specifically in the likes of Total Energies, Shell, for example. I'm even seeing BP and Glencore really taking a beating this morning. But the banks across the board seem to be doing well. Barclays higher by almost 3% this morning. Santander having a good day as well. So this is kind of two major sectors that are very much exposed to the cyclicality with two very different trades on this morning.
Yes, and worth mentioning, reminding ourselves of one of the stories we delved into briefly at the top of the programme around China and the weakness in the PMI data coming out there. Because Basic Resources, as you point out, Kriti, also in the red along with energy. And Basic Resources has a little bit of the PMI China read across and the earnings story because Glencore's down by 3.9%, but the whole sector is under pressure. So that's another sort of piece of macro that lies across the micro that we've been taking seriously this morning.
More stocks up than down, though. So just in terms of breadth, you've got 463 stocks up. You've got down 112. So you are seeing a more positive bias, you could argue, in terms of the breakdown. The banks are really driving this, though, this morning. Barclays is up a very nice 3%. It's the second biggest points contributor in terms of the stock 600 this morning. So the banks are certainly helping. I'm trying to find some of the others. UBS, not up by as much, but rising quite nicely this morning in this market. You do, though, see some of the energy stocks weaker, though. Total is down quite sharply, 2.9%. That's the biggest points drag on this market this morning.
Here's one we haven't talked about just yet. The media sector, actually the best performing sector this morning, and being lifted by Universal Music Group, which is up by more than 6% over in Amsterdam, delivering a quarterly beat, so better than expected numbers there. Subscription growth, streaming revenue nudging up. So this has helped that particular business come in better than had been anticipated.
Just a couple of days ago and was showing some signs of weakness. I'm delving into the back of my memory now, just trying to remember. Spotify shares decline as revenue and monthly users miss estimate. Maybe some switching going on.
We haven't talked about the auto sector yet.
We'll get to it.
We should talk about, well, I mean, we're waiting for the DAX to open here, but some of the early reads you're seeing on the stock 600, beatings are about something of likes about 3%. I'm now being told that the DAX is actually open, but likes of Volkswagen, for example, Mercedes, some of your biggest downside movers as well. And of course, this is probably a reaction function to some of the commentary that's been coming out of the automakers, the suspension of guidance coming out of Stellantis, but also some of the kind of poor commentary and feedback coming over in the States as well, not just from Washington, but some of the big Detroit car makers as well. as well.
Let's get a view on the European equity space. Peter Oppenheimer joins us, Chief Global Equity Strategist and Head of Macro Research Europe at Goldman Sachs. Peter, very nice to have you, on the programme this morning. So we're busy digesting the earnings stories, and there seem to be some contrasting themes this morning. The auto sector once again being beaten up and having to withdraw guidance, it seems, in a number of cases as a result of tariff uncertainty. On the banks, a much more resilient story, so beats coming in from those businesses and sticking to guidance. I suppose that's what you'd expect to see at this stage of the cycle, but the banks could just be lagging behind, I guess.
Well, I think there's something else structural going on, which is interesting. And what those two sectors actually have in common is that they're both considered to be value sectors. And for a long time, a decade or so after the financial crisis, most equities were really bifurcated between growth and value. Things that were growthy consistently did well, things that were value-orientated did badly, including the banks. And that was true for at least a decade or more after the financial crisis. But I think what you're really seeing is a bifurcation among both the growth areas and the value areas. Banks are doing well. We've liked them for a long time. In fact, in the last couple of years, European banks have outperformed mega-cap US technology. Not many people have focused on that. It's sort of gone a little bit quietly under the hood because for so long mega-cap tech really gained all the oxygen. It was so dominant in terms of market focus. But autos are still in a sort of value trap because their underlying earnings continue to come under pressure. Banks are cheap, but they're generating a lot of cash flow, buying back stock, paying dividends, and I think that's why they're performing consistently well. OK, and let's put this in the context of your wider expectations about the earnings season. I see from your notes you continue to expect a drop of, I think, 7% in terms of the Stock 600 profitability, and you point out that that's a lot worse than the bottom-up analysis of analysts' estimates would indicate. What is it that those who are following companies day-to-day are not spotting? What is it that's taking time to filter in to that granular level that you're already seeing in terms of the big picture? Well, look, I think it's not that unusual that there are gaps between bottom-up estimates and top-down estimates, which are more focused on macro drivers. We have growth expectations below the consensus. I think analysts are waiting for guidance, waiting for earnings numbers to come through, maybe to confirm what they might be expecting to shift in terms of their own forecasts. But I think that in a weak economic environment, and that's our central forecast, we think we'll just about avoid recession. In the case of the US, our economists put around a 45% probability of one, so pretty much half-half. You would expect to get very weak earnings. And some of that, from a macro perspective, also relates to composition. Energy, for example, we talked about just earlier, is seeing lower profits. That has an effect on the overall index.
Well, Peter, so much of the first quarter performance that we've seen, or I'll include April in terms of this moment in the sun that Europe has been having, has just been reducing overexposure or underexposure, depending on what sides of the Atlantic you're on. What does neutral look like in terms of regional division between the United States and Europe? What is neutral?
You mean neutral in terms of performance?
Like portfolio management. I mean, how much if you're starting over from a kind of allocation perspective, how much right now should be given to the U.S. and how much to Europe?
Well, I think the context is important in answering that question, because if we look at the period running up to the end of last year, when the sort of US exceptionalism story was really at its height, you had the US market making up around 70% of the world equity market. And the US market itself, you had 5 or 6 companies making up nearly 30% of that index, and the dollar was consistently rising. So foreign investors, European investors, were increasing their exposure to the US to get benefits from currency gains and exposure to mega-cap tech. But what we're seeing now is a reversal of that. The biggest tech stocks have derated among the most in the US market. The US itself has derated more than other markets because it was much more expensive. And, of course, the dollar is shifting. So I think if we were looking at a more normalised, longer-term trend, the US market will probably settle at something like 60% or so of the global equity market. Some of that derating will come from, I think, underperformance, which we're already seeing, and some of it from the dollar normalising, because it's had one of its biggest periods of overvaluation that we've seen in history.
How big a headwind is that going to be? It looks extraordinary at the moment. I'm looking at the screen at the moment. The Nasdaq year-to-date for a US investor is down by circa 10%. It's down by nearly 18% for a euro investor.
Yeah.
How big a headwind is that going to be to my performance over the next 6 months, next 12 months? That dollar story, that dollar factor, that FX overlay.
Yeah, I don't think you can overstate the importance of this dollar shift. And you're beginning to see more of a sense that something structural is beginning to change here. We have seen the dollar rising consistently on a trade-weighted basis for many years. That made a lot of sense given the better growth in the US and the technology-driven story. But as we start to see a convergence of relative economic and profit growth rates, you are starting to see some of that overvaluation unwind, and it's shifting portfolio flows as well.
Does it work the other way?
Yeah.
For a US investor, so the DAX for a European investor is up by 13% so far year to date. The DAX is up 24% if you are a US investor.
Yeah. So I think, again, what we're seeing is, at the margin, a reversal of some of the trends that we've seen being built up over many years. For a long time, US investors had no real incentive to put money outside of the US, because if they did so, they'd lose money on the currency.
Yep.
But there was also not much growth to follow. Most of the growth was being generated in the US in mega-cap tech. That's shifting. And at the same time, for European and other investors around the world, there's a greater incentive to keep money at home, because they feel that they'll lose money if they put it into dollar assets. So I think part of what we're seeing here is also a rebalancing of dollar asset exposure, which I think got very extreme over the last couple of years, and particularly by the end of last year. So I think it is influencing, at the margin, capital flows. We're beginning to see it in equities as well as in the currency.
Why aren't we seeing more suspension of buybacks from corporates on both sides of the Atlantic, given all the volatility that there is? I mean, to me, if you're freaking out about the future, you would want to hold some of that cash in reserve. Why aren't companies doing that?
Well, part of why they've reduced buybacks is partly because of the blackout, coming into the earnings season. So we'll have to see how that develops once we come through.
But they haven't fully pulled back. They haven't suspended guidance the way that you're seeing in Stellantis as one example. Even Total came in with a miss on income this morning, but is still keeping their buybacks. There seems to be some sort of hold on buybacks as kind of like that last domino to fall. What would be the catalyst to that?
Well, I think a lot of the decision-making in terms of capital and cash usage is going to depend on whether corporates really feel there's going to be a recession or not. That's going to be the critical next step, and I think in terms of determining where equities go. We think markets are not priced for a recession. Our assessment is that it's roughly 50-50 probability, a little bit less than that. But, of course, if you begin to see some of the soft data, which has been deteriorating, coming through in terms of the harder data, then I think the market will put a higher probability on that outcome again. Equities will have to pull back, but also companies, I think, will become more cautious in their cash usage.
Peter, it's always great to catch up. Thanks for stopping by to see us this morning. We really appreciate your time.
Thank you.
Peter Oppenheimer, Chief Global Equity Strategist and Head of Macro Research Europe, joining us, of course, from Goldman Sachs. Busy morning. Plenty of stocks you want to be watching out for. Quick look at the Core 6 just to get an idea of some of the bigger names that we watch on a daily basis, just to make you aware of what is happening and update you on what is happening there. As you can see, actually, in some ways, not much movement here. There was quite a lot of movement yesterday. Today, maybe a little bit less so. But believe you me, there's plenty of movement elsewhere. Charlie Wells is here with the details.
Yeah, Guy, we're seeing a lot of movement based on the back of a lot of these earnings reports that we're getting. Let's start with things that move. Volkswagen, Mercedes, and Stellantis all reporting this morning. And we're seeing some green right now. This is probably the market digesting what we got, because we had Mercedes, we had Stellantis saying that they need to withdraw that guidance for the year on the back of this tariff uncertainty. And Volkswagen, they had sales in that first quarter down 40%. So we're seeing green on the screen here, but let's wait as the market starts to digest this. We do have some positivity coming from the potential of Trump softening some of those auto tariffs. Let's see how that plays out. What makes cars move? It is energy. We had some oil giants reporting this morning. They're under pressure, that oil price, putting them under pressure. We've got Equinor down 1.38%. Total Energies down 3.53%. So bad news coming there from these earnings. But what I've got to say is, even though they've got some misses, they still reiterated their buyback plans for the year ahead. If we're talking about buybacks, we need to talk about banks as well. Significant beats from large European banks, and a number of them as well talking about how they are going to continue their buyback plans. That had been a concern for a lot of investors. Let's start with UBS, up 1.56% this morning. They reiterated the fact that they can buy back over the course of this year. That had been a concern. We've got Santander down 1.15%. Also talk of buybacks there, but exposure to Latin America, to North America as well. Barclays up 2.9% and Societe Generale up 5.3%. That has been the best performing bank in Europe so far this year. Now, let's take a look at some music to investors' ears this morning. We've got Universal. This is kind of a fun way to end, up 4.4%. They have had an earnings beat, and they also were able to talk about some of the deals that they've got from the likes of Amazon and Spotify, setting the tone and the tune this morning.
Very nice, musical. Bloomberg's Charlie Wells with the latest on some of the stocks on the move. The sector's in focus. There's a lot happening this morning, and all of it having an impact on these markets, as Charlie's just been illustrating. Stock 600 then up by 0.5% as we digest all of these earnings stories. Coming up on the programme, UBS profit beats then, beating estimates, as traders gain from market volatility. More from our interview with the bank's CEO, Sergio Ermotti. That's next. This is Bloomberg.
That uncertainty is there. It's very positive to see that there are ongoing discussions in terms of finding agreements. Having said that, if this goes on for too long, uncertainty has also a cost, and therefore probably investors and corporates will slow down their investment plans.
The one and only Sergio Ermotti, the UBS CEO, speaking to the one and only Tom McKenzie from Bloomberg in Zurich. Let's take a quick look and see exactly how UBS is faring this morning, because actually we're getting quite a mixed picture out of the banking sector this morning, which I think is interesting. But UBS is up by 1.24%. As I say, Tom is in Zurich. Let's talk about what he learned from Sergio and figure out where we go from here. Tom, the big story is the uncertainty that we're seeing at the moment, but the volatility as well. And that upheaval we're getting in markets presents both, of course, a threat, but a big opportunity as well.
Yeah, and you've been discussing this. I mean, clearly, look, the global capital markets, in terms of the global markets team, the trading unit at UBS coming through with the best quarter that is seen on record because of that volatility. But as you've been discussing, it's a two-sided question, this as well. And that's something that Sergio Ermotti addressed in the interview. Yes, the team trading equities, fixed income and FX performed very, very well indeed. In some, and on some metrics, outperforming some of their European and US counterparts. They saw a 32% surge in revenues within, of course, the global markets team. But the volatility is potentially a risk for this business and others within the banking space going forward. He said there is a little bit of fatigue he's starting to see now amongst their clients when it comes to the question of tariffs, and importantly suggested, of course, there is also the risk that you start to see a pullback in terms of the investments by their corporate clients. And in fact, the advisory business has suffered a little on the back of this. There was a little bit of weakness within an advisory part of the business. Again, not idiosyncratic necessarily to UBS. And then there's a question about what happens in this rate environment and whether or not the Swiss National Bank has to push rates lower than the 25 basis points right now. UBS projecting that net interest income, which came in a little softer, will continue to cool, maybe by about 1 percentage point through the rest of this year. So yes, benefiting from the volatility. Interestingly, in terms of the question on what clients are doing in this environment, not changing asset allocation, in some instances taking advantage of the volatility with volumes at levels that we haven't seen, according to UBS, since COVID.
OK, so we're looking at a sector and here a business that's been benefiting from that volatility in markets we saw in the first quarter, Tom. But we've been asking questions about whether businesses are going to stick to buyback plans as the impact of global tariffs starts to really kick in. But UBS doesn't only have to think about the impact of tariffs, it has to think about a changing capital requirement landscape.
yes, this is the idiosyncratic element of the story when it comes to UBS. And the big overhang, really, for investors looking at this bank, and one reason, arguably, why the stock has underperformed its peers, there is still a big question as to where the regulators go with that capital requirement that could see capital requirements increasing to 20% or about 25 billion US dollars. The government is working through the plans. There's no sign that BaFin or SNB, the regulators or the central bank or the government are walking back these requirements. UBS and Sergio Ermotti, the CEO, have made their call that it needs to be moderated in terms of the potential impact on UBS. They don't have any clarity yet. They're continuing to make their case, and that is something we continue to watch. They have delivered in the first quarter about $500 million in terms of the buyback. They say they're on track to reduce, or at least pay out, I should say, in terms of buybacks, $3 billion US dollars by the end of this year. But that is contingent on what happens with the capital requirement story.
Certainly one that we're going to keep a very, very close eye on. Bloomberg Daybreak Europe anchor Tom McKenzie joining us out of Zurich after that interview with Sergio Ermotti. We thank you so much for that crucial context. In the last 2 hours or so, we've also been speaking to the CEOs, or I should say CFOs as well, in Santander and Crédit Agricole this morning, specifically in terms of how they're reacting to the geopolitical volatility emanating out of Washington and what regions of the world may benefit. Take a listen to what they had to say.
If you look at Latin America is the region that is being the least affected by the tariff increase around the world.
Europe is clearly an area of stability, an area of predictability in terms of regulation, and so Europe should benefit in the long run of all this instability that is developing globally.
Crédit Agricole and Santander executives speaking there too. As I think is striking, though, that two different kind of European banking executives talking about outperformance, in two very different parts of the world. Santander leaning into that U.S. and America's exposure. Jerome over Crédit Agricole saying it's still Europe. Europe is still that bright spot in terms of the reaction function.
Yeah, different geographical footprint there. Both trying to sound pretty upbeat. Santander upbeat about the U.S., saying they don't see a recession there. Jerome, you asked him if he was in the positive bucket or the negative bucket. His bucket or his glass was definitely half full, wasn't it, in the conversation with him? But that Crédit Agricole stock is down by 3.3%. And you asked him about the costs and the tax impact, these sort of slightly more French angle on the earnings story coming through there.
Yeah, and slightly, as you say, idiosyncratic maybe to this bank. I think the bigger picture, my takeaway this morning is the bank. I thought the banks would be much more on the front. I thought the banks would be smashing it this morning. I thought that actually the market would look at the very strong numbers that are being posted on trading and take that and run with it. But that is not the case. The subtlety, the nuance is important. Individual banks, to your point about Agricole, are trading not in the way that you would have thought. Santander, Caixa, all taking hits this morning.
Yeah.
And it doesn't... This feels like our positive sector this morning. The car sector,
on the other hand,
does not feel like our positive sector. So heaven knows what's happening there.
Right, so let's check in on that. Mercedes and Stellantis have withdrawn their outlooks for the year due to the uncertainty sparked by President Donald Trump's trade moves. Let's bring in Bloomberg's Oliver Crook, who joins us from Berlin. Ollie, talk us through these decisions from these businesses. Not enough information, I suppose.
Yeah, so listen, Anna, when you actually look through the numbers and what we got today, this is a very quite poor first quarter, and this is before we even take into account any of the effects of the tariffs, which of course really kicked in at the very beginning of the second quarter. When you look at what we got out of Mercedes, revenue down 7%, earnings before interest and taxes down 40%. Everybody's margins across the board are getting squeezed. We saw that at Volkswagen, we saw that at Mercedes. Stellantis didn't divulge their margin, but of course that's also getting hit. When you look at the unit sales in terms of the different markets, you see that Volkswagen, for example, losing 2% in the United States, losing 6% in China. But what I think is really interesting, we can go through all of these numbers and how poor these numbers have been in the first quarter. There's a couple points to make. Basically, all of these companies have withdrawn their outlook. Stellantis and Mercedes officially. Volkswagen said that their outlook is unchanged, but it doesn't take into consideration any of the impact of tariffs. I'll consider that a withdrawal of the outlook. But when you look at what Mercedes was actually saying, the tariffs are one side of this. Of course, these European car makers are singularly sort of affected when they think about the cars that they're going to ship into the United States that now they need to pay an extra 25% on. But on top of that, we need to take also into account that this is a deeply cyclical industry. When you have any kind of effect to the macro environment, you see slowing down across the globe, that is not only going to hit sales in the United States, this is going to hit their entire business globally. And that is what these car companies are contending with, and they're basically totally unable to give any picture of what the rest of the year looks like. We can anticipate, though, it will get worse.
Okay, so walk me through what Volkswagen's saying. Volkswagen this morning is sticking to guidance in theory, but it's not really. It's basically saying, here's our guidance without folding in any tariff impact. The numbers are pretty ugly. How much use is this? What do I actually know about what is happening at Volkswagen at the moment?
Well, listen, what they've told us is when we look at their sort of unit sales, you look in the first quarter, this is where things get a little bit interesting. This gives you a flavor of what's going on around the world. Europe is up 4%. South America, I will say South America is the only bright spot, up 17% in Volkswagen. I think for Stellantis, they had something up 19%. This is apparently the only bright spot within the car sector. But then again, you look at their sort of operating profit down 40% over at Volkswagen, their return on sales and their margin going down to 3.7%. That's down from 6%. But you're starting to see even for luxury car makers, they're starting to report margins that are more on par with the sort of volume sector. This is a very bad sign and very discouraging for the auto sector more broadly, Guy.
Discouraging. There's a good word. Maybe a slight understatement as well. Ollie, great stuff. Thank you very much indeed. Ollie Crook on the auto sector. Coming up, President Donald Trump marking his 100th day in office. We'll talk about the impact next. This is Bloomberg.
This is the opening trade, about 30 minutes into today's session. Seeing some green on the screen. The last 30 minutes, you've really seen the markets pick up in a very big way. Outperformance in the DAX, higher by 0.7%. But the French index right on its heels to the tune of 0.4%. A lot of this is going to be an individual earnings story that are kind of seeping up to the surface as opposed to a fundamental change in the narrative. I want to really zero in on the banks, of course, because we are getting numbers from every corner of continental Europe. I was reminded in the commercial break that Santander is now the largest bank by market cap in continental Europe and the underperformer of the morning in the bank sector, down about 2% this morning. It looks like a lot of the weakness coming out of Brazil and in the UK, weighing on some positivity in the United States and LATAM. Some of the other banks, though, Guy, having really good days, really strong numbers across the board.
You're seeing big dispersions in terms of the bank performance that we're getting across Europe this morning. Some of the Spanish banks certainly under significant pressure, some of the French banks as well. UBS maybe at the other end of the spectrum. Barclays having a good day as well. Certainly its trading operations doing very well right now. Let's turn our attention to the source of some of that volatility. President Trump, the first 100 days. President Trump holding a rally in Michigan last night to mark his 100th day in office. He championed his economic policies. He renewed criticism of the Fed chair, Jerome Powell, and once again took aim at China.
China's taken more jobs from us than any country has ever taken from another country. And that doesn't mean we're not going to get along. We get along with China. I mean, the tariff now is at 145%. So essentially, that's a big difference between that and zero. But I think it's going to work out. They want to make a deal, and we're going to make a deal, but it's going to be a fair deal.
And it may take a while to get to that deal, and certainly saw the impact of that on the Chinese PMIs overnight, the official number dropping below 50, just starting to get some of the effect coming through of this tariff war on the global economy. Let's assess what we've learned in the last 100 days. How much has changed? The tectonic shifts that we have watched. Jennifer McKeown, Global Chief Economist at Capital Economics, joining us around the table. How would you characterise, from an economist's point of view, and please don't say on one hand and on the other, what we've seen from Trump? But be definitive. How would you characterise it? What has been the effect in terms of how your models have changed, how you've perceived what the global economy is going to look like going forward from here?
Yeah, OK. Well, from an economist's point of view, it's been incredibly busy, very interesting, great time to be an economist. From the economy's point of view, the big theme is uncertainty, isn't it, and volatility. We're seeing that in markets, but we're seeing that in measures of business confidence, consumer sentiment. I think, broadly speaking, his policies are stagflationary for the US. For the world, something of a dent in growth, if nothing else because of these confidence effects, but also the direct impacts of the tariff.
Can you just talk me through? So one of the things that I'm really struggling with at the moment is trying to read the data and understand what it's telling me about kind of the effect that we have seen. Because a lot of the data, particularly the hard data, is very rear view mirror stuff. Some of the soft data gives us a more current, kind of higher frequency read of what is going on. Can you just kind of sequence for me how long you would expect the full effect of the Trump tariff story, the shifts that we're seeing, to affect both the US economy and the global economy?
OK, it's difficult to say because it depends really where we end up in terms of tariffs. I don't think we're done by a long shot in terms of what he was talking just there about deals to be made with China. But I think in terms of the sequencing, what we'll see is, well, we've already seen this drop in confidence, this stress in financial markets, and we're seeing this front-loading of imports because of tariffs that are to come, front-loading of US imports. And that's really distorting the data. So we're going to see some weakness in Q1 GDP in the US because of that. I think we've got that later today. And
but it's not showing up in things like the labour market yet.
No, it's not showing up in the US labour market, is it? Again, we've got non-farm payrolls later this week. I think they'll still be pretty solid, maybe 150,000. So, yeah, we're not really seeing it in the US labour market yet, but we are certainly seeing it in confidence, not just in the US, but more broadly all over the world. We're seeing this big impact, businesses and consumers.
Yeah, and we were speaking to the Santander CEO. They have a big business in the United States, specifically, well, around auto loans, used car loans, for example. But he was telling quite a positive story and saying a lot of this comes down to the labour market. But help us understand the micro where it meets the macro, if you like, Jennifer, because on the one hand, we cover stories about Fed job layoffs, you know, federal officials losing their jobs, and lots of corporates starting to tell stories about job cuts. We got just one yesterday from a big US corporate. And yet the non-farm payroll story is sort of steady as she goes. When do the two meet?
Well, I think probably they meet somewhere in the middle. Those government job cuts, they're not having a major impact on the aggregate at the moment because the private sector's holding up OK. Again, a lot depends on just where we end up on tariffs. If we see this further relatively conciliatory tone, if we get some kind of a deal between the US and China, which brings those tariffs down, which I think we will, then I think on aggregate the labour market should be able to hold up OK. Broadly speaking, the US economy is still in a fairly decent state.
And how important is it for the global economy that we do get at some sort of deal between China and the United States? Because whilst President Trump last week was being a little more conciliatory to China, just over the last couple of days we heard from Scott Bessent saying they'd sort of set aside the China problem. They were focused on other trade conversations, like India, for example, rather than... And there was this sort of opacity as to whether there were many conversations taking place between China and the US at all. But this is the world's largest and second largest economy with huge trade flows between them. So you would expect, I guess, from an economic perspective, that trade deal is the most important to get done, is it?
It's really important. I mean, the US is walking a pretty difficult line in trying to say that it's going to stand tough against China. But on the other hand, it is the world's second largest economy. There does need to be a deal that brings those tariffs down from the rates we're seeing at the moment of over 100%. And that's very much in the US's interest. So I'm pretty sure it will happen. But it will need to be done in a way that seems that neither side has lost face. Because what we need to remember is that China's response, as well as Trump being more aggressive than maybe we'd feared, China's response has really been more aggressive than most people had assumed that it would be. So it's not for backing down, except on terms that kind of suit it to some extent. So, yeah, I think we will see pullback, and that is important for both economies.
Talk to us a little bit about the kind of, aside from the trade story, the other piece of this that the White House has been focusing on has largely been the kind of cuts in terms of efficiency. So in the likes of DOGE, in terms of laying off federal workers and really pulling back on things like defense contracts, which have been a big piece of government spending into the U.S. When does that all show up into the data?
Well, I think at the moment it's being largely offset by the private sector, and the private sector holding up relatively well. So assuming we do get this pullback and that for example, the labour market remains relatively resilient, then I don't think it is going to have a really major impact on the broader economy, not least because I think there's a bit of a pullback from this DOGE initiative at this point. We've seen Elon Musk stepping back fairly significantly lately amid some differences of opinion on tariffs, let's say. And so I think that's going to mean that this isn't really the major theme for the rest of the year.
There's a narrative out there that any sort of cost expenses that the Doge and efforts have actually produced have been completely offset by the volatility of these markets and the potential increases and losses you've seen, not only in the stock market, but in terms of the rate increases as well. Does the math add up there? Does it offset to that extent?
I mean, I think it's difficult to work out exactly what the sort of 0.2s and 0.3s are here and there in terms of the impacts on GDP. But I think broadly what we're seeing is that Trump's policies are somewhat counterproductive for the US economy. It's very hard to see the positives at the moment, and I think that's why going forwards for the rest of this year we're going to need to see more focus on fiscal policy and on how these tariff revenues, assuming that they come in, are going to be recycled into the economy to mean that you don't get this net drag, but that at least on balance perhaps it's neutral for the US economy if we can recycle these tax revenues into maybe tax cuts for blue-collar workers.
And thinking of fiscal, takes me to Europe, specifically Germany. We have Germany's Social Democrats voting in favour of a coalition deal with Friedrich Merz's Conservatives. So that clears the way for the CDU-CSU leader, Merz, to become the Chancellor next week. So that's sort of tick. We thought that was going to happen, and it has happened. So maybe that's a relief to markets who like things to happen in a predictable way. Of course, there is a link between the Trump conversation and what we're seeing in Germany, because a lot of the US stepping away from Europe in terms of the military umbrella is being picked up by Germany, saying, OK, we're going to spend more on infrastructure, yes, but also on defence. What's the latest thinking on how material this is going to be and when, crucially, for the German economy?
Well, we've said that it could add something like 0.7% to German GDP, which is really significant for an economy that's barely growing.
But does that wait till next year, or is that? Yeah,
it will take time to come through, yes, and probably is not until next year that we really start to see this boost taking effect. But already, I think it's probably improved market sentiment towards Germany, and investor sentiment more generally towards Germany. And it's really interesting that it's not only defence, as you said. It's caused this more general overhaul of the debt brake, which we've always thought was a major constraint on German growth, and this push into infrastructure spending, which could, help to offset some of the negatives of US tariffs, maybe even more than offset them over the longer run.
Well, the key risk from U.S. tariffs from a consumer point of view on both sides of the Atlantic is the kind of inflationary impulse that follows. I'm curious how cushioned the European consumer is relative to maybe an American consumer that is still working through a lot of excess liquidity in the system.
Well, I mean, it's certainly the case that the Eurozone economy is weaker, starting from a weaker starting point, which means less inflationary pressure. And we are seeing that in the data. I think in the Eurozone case, inflationary pressures are hopefully pretty much behind us now. Wage growth's come down quite a long way. And, of course, the tariff effects are just totally different. If we assume that there's not a major retaliation from Europe, which is what we're assuming at Capital Economics, then you shouldn't see significant inflationary pressure in the Eurozone. And in fact, the drag on GDP growth might mean that on net it's a disinflationary impulse. So that leaves the ECB, we think, able to cut quite comfortably a bit further, whereas for the Fed, there is clearly going to be an inflationary impact from these tariffs. It should hopefully only last for a year from when the tariffs are implemented. But there's a risk of second-round effects into wage growth at a time when US inflation is already a bit sticky. I think that's going to mean that the Fed can't cut further this year and that it's got to wait until next year for any further loosening.
It is wild that being a structurally weaker or having a structurally weaker starting point is actually playing off as a benefit in this moment. Jennifer McCown, Chief Global Economist over at Capital Economics, joining the program this morning to walk us through all of the headlines coming out of Washington, D.C. We thank you so much. Coming up, we stick with the conversation happening out of the States. Tech, especially, having another big earnings week. Microsoft and Meta reporting after the U.S. bell today. We're going to preview some of the numbers out of those mega cap companies. Stick with us. This is Bloomberg.
Welcome back to the opening trade. It is Wednesday, the 30th of April, and we are 46 minutes into our European session. We have gains at the index level, not as much as we had earlier, actually. We're up by 0.2%. We've actually unwound some of the earlier gains. We're seeing strength coming through in some of the banking names, but not all of them, and weakness certainly in the auto sector around the narrative attached to autos, at least. But that's what we're dealing with when it comes to the overall indexes, then, Kriti.
Absolutely, and plenty to still digest when it comes to the day ahead. Things like German CPI, which is hitting at 1 p.m. UK time. We've got plenty of earnings coming out of the States as well, and data. Let's bring in Bloomberg's Valerie Titel on what she's looking ahead to this morning. Val, walk us through it.
Hey, this morning, or I guess later this afternoon at 1:30, we were getting some key macro data, that being the first advanced reading of first quarter GDP for the U.S. And I think this one is going to be the interesting print of the day. And I say that for a few reasons, one of which being is that the range of estimates for this print by economists is 4 percentage points wide. It is incredibly wide, the largest range that we've seen on a GDP print. A lot of uncertainty, a lot of unknowns. The big question is going to be, how much did the surge in imports lead to a drag on GDP? Yeah. And then with the personal income and spending data, how much did consumers really front-run these tariffs by front-loading purchases in the first quarter? That's hopefully the narrative we'll try to figure out today from these two data prints.
There should have been a box that said, don't know. And then we can tick that one and everybody kind of would, rather than just putting in a number.
Yeah.
Kind of gives us this sort of spread. You've got refinancing as well. There's plenty of things to worry about. Do you think the GDP's the risk event, or do you think the refinancing number could be a risky event as well?
Well, I think for the quarterly refunding update from the Treasury, there seems to be a consensus that there'll be no change in the coupon auction, so that might come later in the year. So I think that one won't necessarily attract a lot of market's attention. But I think a lot of the discussion will be on what does this surge in imports mean? If we do get a bigger than expected surge in imports, could that actually be a good thing? Because that means maybe these corporates have more of a cushion if we do get this supply shock. Maybe you could argue that if this front running of tariffs, the surge in imports was way bigger than expected, it could be a great thing for quarters to come, because that means that these companies, will have inventory to deal with, reordering their supply chains amidst, getting their supplies.
We'll see in the ISM data on Friday. The manufacturing ISM will have a clear line and a clear read on what that tells us.
Not great for their working capital if they're running those big inventories, because, there was a reason everyone was just in time before COVID, and then they were just in case, and that's where we seem to have landed. Val, stay with us. We'll come back to you shortly. Let's think about other things that still lie ahead, and one of those is big tech earnings. Meta and Microsoft are due to report after the bell today. AI costs and ad revenue will be the main focus amid global tariff uncertainty. Let's bring in Charlie Wells, who's been looking across the sector, working out what we need to brace for when it comes to the earnings story. So let's take them one by one to start with. What about Microsoft? I was looking briefly at this, Charlie, and there's a lot of focus on data centers. There's been some really interesting reporting about the extent to which Microsoft is pulling back on data center construction plans. Tell us more.
Well, it feels like DeepSeek and the fears around AI spend were like 3 centuries ago.
It does. It does.
And maybe Microsoft is happy about that because, yes, they've been walking away from some of these data center projects around the world, and that could indicate that they're worried about the spend. But, don't forget that Microsoft has been actually pretty good at monetizing AI, right? So they've been able to leverage that partnership with OpenAI. They've, been able to kind of really make that work for them. So I think it's kind of squaring the circle on Microsoft that we're going to be watching.
Talk to us a little bit about the advertising space. Guy, I'm told, has a Snapchat account somewhere, and he was talking about it, which is shocking because I haven't used Snapchat in some time. But Snapchat came out with some scary numbers. Meta is going to be coming out later today. Is that a line that we can draw in terms of a read on investment for the broader economy?
Yeah, so, a majority of Meta's revenue comes from advertising. They're basically an advertising company. And I think if you want to think about, another kind of scary figure for them, I guess, as far as a bar set high, Alphabet reported really strong search advertising revenue last week when they reported. And I think advertising is interesting, right? Because you get this kind of read from the broader economy, from other firms. Are they willing to spend in order to, get that exposure? And I think that's going to be hotly in focus. There's also a lot of kind of issues about advertising from China. Meta's got some exposure there. Let's see how that plays out. Snapchat guy, I can't speak to your account. I'm sure it's great.
To reply.
Qualify here. My children, teenagers, definitely still use Snap.
I'll be honest. I'm sure you've fiddled around with it.
Never happened.
But I mean,
but I know a lot about it.
And I mean, that does speak to the fact that, like, is Facebook still the hot spot to advertise? Is it Snapchat? It's Facebook? Yeah. It's really competitive, so...
Okay. Never had a Facebook account either, but maybe I'm too old for all of this. Yesterday, I did have an Amazon account, amongst other accounts that I have. The spotlight the White House spotlight turned on Amazon yesterday in a very big way. Bezos has tried to get his relationship with Trump back on track. To a certain extent, he has clearly done that. How much damage was done yesterday?
I mean, this felt like Amazon kind of using the Trump playbook, right? Doing something kind of showy, doing something kind of brash, you know, basically an idea that was floated and maybe some parts of the business.
Do you think deliberately? Do you think this came out?
It's hard to say, but what I would say that's kind of been missing on this side of the Atlantic is that companies do, on receipts in the United States, list taxes, right? When they're not happy about a tax, often they'll list, like, you know, health charge. If a city has a kind of like base, you know, health charge, they put sales tax in a lot of different states. And so it's not totally unreasonable for the consumer in the United States to see the taxes that they're placing.
Makes shopping in the States very confusing.
I know.
In my
you say
experience.
it's underappreciated. I think it's very much appreciated because we have probably all been caught out by the fact you go up to,
it's
you go
how
to buy
much?
something and it's not the price you thought it was because, you know, we're slow. And that's the European approach. Let's come back to you then, Val. We're waiting for all of these corporate earnings around the tech space. You were talking earlier about where the Nasdaq is. I'm looking at Nasdaq futures down by 0.3%. There's a whole heap of nervousness about what big tech does because, as you were saying, Charlie, many centuries ago, before we were worrying about tariffs, we were worrying about whether the AI dream would live up to high expectation.
Yeah, part of the big U.S. exceptionalism trade, being overweight to mega cap U.S. tech. But, think about the big picture here is that the equity market and the tech indices, the NASDAQ 100, has been on a really great footing recently. It's had quite a heck of a run the last few sessions, and NASDAQ 100 has erased nearly all of the April 2nd tariff-induced sell-off. I mean, that is quite a statistic when you think about just how vulnerable, as Charlie, you were mentioning, some of these companies are to ad revenue, which is highly, highly cyclical.
OK, thank you both very much. Thanks to Valerie Teitel and to Charlie Wells, helping get us set up for some of the macro data and some of the corporate reporting that we're going to get out later today, Guy.
Tariffs, though, absolutely front. You think about the morning we've just had.
Yes.
Uncertainty writ large across all of the conversations we've had with CEOs, CFOs, deputy CEOs. It's been the narrative that has obviously been running throughout everything. Obviously, we have watched very carefully what has happened in terms of the announcement that Donald Trump has delivered since becoming president, upending markets that have undermined economic and corporate sentiment in a big way. Even as many levies have been delayed, modified, delayed again, modified again, delayed again. You get the picture. We gauge the impact of these US import taxes amongst top regional executives as we've been watching how this has all unfolded, as this week marks the 100 days of Trump's second term in office.
There are signs that that investments might start getting delayed if this continues for too long.
We see tariffs are changing pretty often, leading to uncertainty.
We are seeing impact now in terms of incoming container traffic into the U.S. and so on. So starts to have some real economic effects.
We believe that tariffs are not the best way to manage this, to manage pharmaceuticals.
Everybody is discussing the impact that tariffs might have.
Obviously, it's hard to predict what will happen in the next 90 days. What we are not seeing yet is that they are actually delaying projects or even cutting projects.
We don't see any hard evidence of that playing through at this point in time. But again, we know those things can change in a heartbeat, so it's on the risk register.
Are you expecting the tariffs to come back down? And again, you don't know whether a tariff is put in place now.
I don't know. I think there is one guy who knows, and it's not me.
President of the United States, the buck stops there, but everybody's trying to manage it. And it's really interesting this morning. So the auto sector is largely withdrawn guidance. We don't know. Economists, Val just talking about the range that we're seeing in terms of expectations for GDP today. We don't know. The banking sector is a little bit different. Yeah. Talking this morning fairly positively, not expecting a recession, not seeing an impact on the credit story. Is that a story that we've got to play catch up to at some point.
Maybe, yes, you were reminding us of the COVID impact. All the volatility in the early days.
Yeah.
Great for trading.
Yeah, exactly.
Well, great for the banks, but I think there's a cohort of companies, I'm not going to say they're in the majority, but there's a cohort of companies on both sides of the Atlantic that are still actually kind of insulated from this because they're more exposed to kind of long-term investments, and therefore they think they can see through this. Honeywell in the States was a great example. I'm still waiting for examples here in Europe.
Akzo Nobel was in that clip we just played. Yeah, they make heavy things. You don't ship them very far. This seems to be one of the secrets.
Yes, so you have to have domestic production. You are geographically hedged. That is it for this show. The Pulse is next. Hope you enjoyed it. This is Bloomberg.